our group analyzed the company Merck Co. The company was established in 1891 as the United States subsidiary of the German company Merck, which was founded in 1668. Then, since 2001, Merck Co. has been acquiring huge competitors and suppliers with the objective of expanding and verticalizing part of its operations. And it's also the seventh largest pharmaceutical company by market capitalization and revenue, and its headquarters are located in Kenilworth, New Jersey. The company is listed in the New York Stock Exchange under the symbol MRK. It has 60,000 employees spread over 100 countries. Their field of action is pharmaceutical, vaccines, and animal health care products, producing and researching for diabetes, oncology, infectious diseases, cardiovascular diseases, sleep disorder, and women's health. The most profitable country is United States, with approximately 40% of total revenues. As it is possible to observe, Merck Co. is mostly owned by huge holdings, totalizing 2,119 companies. They own many shares in just one holding, Vanguard, which holds more than 10% of MRK. On the other hand, the company is also owned by individual investors, whose shares are mainly divided into the members of the executive committee. Kenneth Frazier is the chairman of the board and CEO, and Adam Schlechter is the executive vice president and president of the Global Human Health Department. The market in which Merck Co. conducts its business and the pharmaceutical industry itself are highly competitive and highly regulated. The company's competitors include other worldwide research-based pharmaceutical companies, smaller research companies with more limited therapeutic focus, and animal healthcare manufacturers. Pharmaceutical competition involves a rigorous search for technological innovations and the ability to market these innovations effectively. With its long-standing emphasis on research and development, Merck is well positioned to compete in search for technological innovations according to Valor Econômico. The company is active in acquiring and marketing products through external alliances such as joint ventures and licenses, and has been refining its sales and marketing efforts to further address changing industry conditions. However, the introduction of new products and processes by competitors may result in price reduction and product displacements, even for products protected by patents. The company's focus on revenues from emerging markets has increased. Governments in many emerging markets are also focused on constraining healthcare costs and have enacted price controls, such as compulsory licenses, that aim to put pressure on the price of pharmaceuticals and constrain market access. Other conditions in emerging market countries can also affect the company's efforts to continue to grow in these markets, including potential political instability and significant currency fluctuation and controls. The company's products range from vaccines and oncology to animal health. A large portion of Merck Co.'s revenues are generated from primary care and women's health products. The drug generated almost $4 billion in revenue in 2017. As a company, Merck Co. has one of the highest numbers of approved drugs, spending significant amounts on research and development. As for its main competitors, the ones that will be analyzed by the group are Pfizer, AbbVie, Johnson & Johnson, and GlaxoSmithKline. Pfizer was founded in 1849 in New York by Charles Pfizer and Charles Erhardt. It pioneered in the production of antibiotics. Today, it brings in its portfolio about 100 products in different therapeutic classes. Johnson & Johnson was founded in 1886, and it's an American multinational medical devices, pharmaceutical, and consumer packaged goods manufacturing company. Its common stock is a component of the Dow Jones Industrial Average, and the company is listed among the Fortune 500. In 2011, Abbott Laboratories separated into two publicly traded companies. The new Abbott Laboratories, AbbVie, would be specialized in diversified products including medical devices, diagnostic equipment, and nutrition products. However, it would operate mainly as a research-based pharmaceutical manufacturer. GlaxoSmithKline is a British pharmaceutical company headquartered in London. It was established in 2000 by a merger of Glaxo Wellcome and SmithKline Beecham. It is a producer of organic health focusing on vaccine products. As it is possible to observe, based on these graphs, the global leader of the pharmaceutical industry regarding revenues and therefore market share is Johnson & Johnson. Merck is on the 7th position. We also analyzed the scenario focused on vaccine revenue market share in 2017, which is a huge important niche for Merck, since it has important operations on this business. We can see that Merck is the second player and its revenues tend to reduce in 2024. However, this likely decrease will not make the company lose its second place. Now, regarding the financial analysis, pharmaceutical companies are characterized by high capital expenditures on research and development, and having to endure a long time span between initial research and finally getting a product to market. Once a pharma product reaches its marketplace, the company needs to determine how high a price the company can command for a drug in order to earn a profitable return on its investment as quickly as possible. Key financial ratios for pharmaceutical companies are those related to R&D costs, the company's ability to manage high levels of debt, and profitability. Merck's ratios shown on the table reflect the company's core business, which relies on on investments in machinery and technology and research and development. Both require high amounts of investments that the company may collect from shareholders or debts. Therefore, one important ratio to analyze within pharmaceutical industry is the return on research capital ratio, which provides the gross profit that a company gets from each dollar of R&D expenditures from the previous year. We can notice that Merck is below the market. They are not receiving as much payoff from its investments as the competitors. This can also be proved by analyzing the return on equity and return on invested capital, where Merck remains significantly below. The ROIC pick in 2015 from the market is explained by the competitors' leverage, which provides higher returns in the short term. Regarding EVA, Merck has very well positioned in 2014, but it has been destroying value throughout the following years. The market, however, has gained value in 2015 and ended 2017 destroying value as well. The industry is losing value, which means that the whole market is not generating value from its investments. Another interesting ratio to be analyzed is the return on asset. The market as a whole has a larger amount of total assets than it's generating revenues, but this can be explained by the total fixed assets, such as laboratory machinery, and the R&D. At the end, the company's assets do not generate enough revenues. This piece of news shows that Merck is focusing on R&D development and investment. This explains the low return on asset. However, the company needs to be aware of its investments and if they're providing value in return. The company should also have a better follow-up of its investment and analyze if its NPV is positive and covers the opportunity cost of the market. Regarding the efficiency ratios, it's important to pay close attention to the asset turnover, the inventory turnover, the accounts receivable turnover, and the cash conversion cycle. Analyzing the asset turnover, we can see that Merck is below the market, which in this case means that it's being more efficient than its competitors since its sales is covering its total assets better than the others. It also makes sense to have this ratio below 1 because within this industry, companies need to invest in fixed assets and R&D, which cause this inefficiency. Regarding the inventory turnover, Merck is also better than the market since its inventory is replaced in a faster speed, which can be proved by inventory days in the table. Accounts receivable, although Merck was better in 2014, throughout the other years it became less efficient than its competitors. This can be a consequence of a moderate consumer bargaining power that obliges the company to postpone its receivables in order to increase sales. The cash conversion cycle of Merck is significantly below the market, which can be interpreted as an inefficiency of the company to convert its investments and production costs into sales and cash. Both accounts receivable turnover and the cash conversion cycle are related. Finally, we can infer that the whole market is inefficient, but it's normal since companies focus its efforts on R&D and investment in sales and efficiency becomes secondary. Because pharmaceutical companies must make large capital expenditures on R&D, they must be able to maintain adequate levels of liquidity in order to be ready for unforeseen events and future needs or investments. Liquidity ratios measure a company's ability to pay debt obligations and its margin of safety. It is possible to observe between the years 2014 and 2015 that Merck was a little bit below the market median, but it was following the same path as seen in the graph. However, in 2016, it suffered a change and the company started to perform a bit better than the market. In this analysis, it's possible to conclude that Merck, in comparison to the market, became more liquid, having either more current assets or reducing its current liabilities. Our group found the explanation for this variation. Merck succeeded in producing a new product which made them increase their current assets by earning more cash, and it also made the value of the shares increase a lot. In addition to that, a big competitor lost market share, contributing to this positive change for Merck. This change in 2016 impacts also the working capital to asset ratio, which made Merck overcome the market performance regarding this measure in 2017. As explained before, because pharmaceutical companies must make large capital expenditures on R&D, they must be able to maintain adequate levels of liquidity and effectiveness to manage their characteristically highest levels of debt. As seen on the graphs, Merck's debt is getting higher. That is because it is investing more and more in research and development. However, it is well below the median of its competitors. That happens because GSK and AbbVie are very leveraged, which rises the median of the market and it makes it seem like Merck should be more leveraged to reach the market's level. But that is not exactly true. We can also see that the company's debt ratios are increasing. That means that it is spending more and more on research and development. The book value represents how much the company would have in assets if it went out of business today. Market capitalizations represents how much investors are willing to pay or receive for a share on the secondary market. Since this price is determined by supply and demand, it does not represent the real value of the company. The decrease of the book value of Merck along these 4 previous years can be explained because of the lower value that the company is creating from its shareholders' investments. However, Merck is still well positioned on the market and the prices of its shares are not decreasing significantly. In order to compare both values and analyze if the share of the company is undervalued or overvalued, we use the market to book ratio. The market-to-book ratio is an indicator that measures the value of the company to its shareholders based on the relation of market value and book value. It shows also future expectations about the company's performance. Looking just at the ratio of Merck, the company is overvalued since its market cap, representing the market value, which are the prices per share that are traded on the secondary market, is higher than its book value. In 2014, the company was overvalued at 2.3 times, achieving 3.43 times on 2017. However, the market is also overvalued even more than Merck. The market value added represents the capacity of a company to increase value to its shareholders in a long time. Comparing all analysis, the ratio of the company compared to the market oscillated along these 4 previous years. In 2014, the company was creating less value to its investor than its competitors, but in 2016, Merck increased its MVA, providing $122 million as value. But as EVA decreased significantly on 2016, MVA increased just because the market capitalization of competitors decreased. Hence, MVA is not an accurate tool to analyze the value creation to its shareholders. After calculating the CAPM of Merck and its competitors, we can infer that Merck Co. is a moderate risky company with an expected return of 7.78%, which is 2 percentage points above securities return, and that AbbVie is the most risky to invest in, mainly because of its leverage. As said before, it is understandable to have odd ratios regarding profitability and efficiency ratios. However, it's extremely important for them to have a deep analysis of its future projects in order to calculate the firm's forecast cash flows and NPV and make the final decision. As analyzing the ratios regarding liquidity, we saw that cash ratio is smaller than 1, proving that current liabilities is higher than cash plus marketable securities. Due to this, it's important for the company to be in alert and make sure it will be able to cover its short-term liabilities. Considering the performance analysis, the company is overvalued just as the market itself, meaning that this sector is a great option to invest as the expectations for the future are positive. As stated earlier, the ratios create a false illusion that the company is much less leveraged than all the others. However, it resembles some other companies in the market. In addition, considering that it's investing more and more in R&D, it's normal for it to have higher levels of debt, and decreasing this should not be the focus of the company. Merck Co. is a good investment option for moderate investors who are risk neutral, laying between risk averse and risk seeking. The company is in a consolidated sector that seeks for research and development of health products and with high performance. Likewise, it is not leveraged as the market and performs similar to its competitors. Hence, we decided to invest in Merck Co. for being a low risk investment decision.